Crude Oil Inventory Report trading. Crude Oil Inventory Report trading. So now first look at what is crude oil inventory. The Energy Information Administration's crude oil inventory measures the weekly change in the number of barrels of commercial crude oil held by US firms. The level of inventories influence the price of petroleum products, which can have impact on inflation. So why does it even bother uh, to be concerned about crude oil inventory reports? One of the main reasons is US companies have considerable power to manage the price in short run than other companies put together. Because of their geopolitical influence and purchasing power, and other than all, these crude oil futures, like US crude oil futures, are traded in a more regularized framework, so that investors and traders alike trust this instrument. And most of the exchanges around the world, commodity exchanges around the world, take this as the reference price for their crude oil futures. So, how to read crude oil inventory report? In essence, the crude oil inventory report is a comparison between two values, forecast and actual. The forecast is given upfront based on a calculation, and actual is released usually on every Wednesday of the week, 9:30 a.m. and 10 a.m. Eastern Standard Time. If we compare it to in India, it will be around 8 p.m. in India on Wednesdays. And forecast and actual can take positive and negative values based on the conditions of the market, supply and production. So now let's look at an example and see what will be the decisions. Say suppose if the forecast is 1 and actual reported was 5, then we say it's a bearish market. And if the forecast is 5 and the actual is a little less and 2, and then we say it's a bullish market. And with every bearish market, we tend to go with the sell orders, and with a bullish market, we go with the buy orders. So let's look at discuss about the decision points. To understand it in a very simple way, view forecast as demand and actual as supply. So the decision points will be, if the demand is higher, the price goes up, and if the supply is higher, then the price goes down. The main point to take down here is sometimes the demand is expressed in negative values, and then you have to be a little bit more careful while taking the decision, but the central theme remains the same. uh, and one more thing to add is, though this has been theme for a long time, over speculation has flooded the market with unnecessary position during these trading hours. So there is a huge price volatility at these hours that are most times inconsistent with strategy. So this one has to digest this fact as well. So let's now see how to trade these reports. Now, when we try to trade on this strategy, we must decide what risk you are going to take, since it can be lucrative as well as unprofitable. And also there is opportunity to take a decent profit regularly as well with this strategy. So you have to decide what you're going to do with it. So the report comes on every Wednesday at 9:30 a.m. Eastern Standard Time. Other than when there is daylight savings in US, that time it comes at 10:30 a.m. So now, just generally, let's see how we, based on this report, how can we trade. So in a day, on the usual days, we can split the day into two parts, like uh, the market before the report and market after the report. And how the market behaves on during these 2 hours really matters for a trader. So first we have to find out is, what was the market before, and with some kind of strategy we have to find out what will be the market after this report. Now let's look at the overview of the board process, like how we can integrate this into our trading method. So there are a couple of ways we can introduce this into our trading method. So we have to split this data into different parts. So we on the day of the trade we have, before the report there is a time, and after the report there is a time, and obviously then entry comes, then exit comes. So we have to study what was happening before the report, and we have to study we have to predict like what is going to happen after the report, and once the report comes, and once we decided if there is a trade opportunity, we have to enter the market. Obviously then we have to either exit once our profit is hit or a stop loss hit, or if you are comfortable, we can carry forward the position as well. So now the question comes like, how can we check the previous trend? For this we can see what was happening in the market for the last 1 week, and what was happening in the last day, and this it has to be calculated with volume, and from there we have to see if there is any major news in the news is floating around, and we have to see what is there any block transactions that was happening, and we have to see is there any OPEC meeting or something is going on there. And so a general trend is whatever the trend was in the previous before this report comes. So something should be happening, right? It's be either a trending market that is going up or down, or it may be a sideways market. So we have to know what was happening before the report to arrive, before the report arrives. Now let's see what we will do after the report comes. So as you already discussed earlier, we know what we have to do when the inventory report comes. So we can find out already. We know that how to find out if uh, it's a long, if it's a bull market or bearish market. And in previously we have learned what was the general direction of the market. So if the general direction of the market is long and the inventory report also says long, then we can go for the decision of long in the market. And if the general direction of the market is in decline, or short, sell or short, then inventory report also says short, then we can say we can go for we can go with the decision of shorting the crude oil futures. Now there are times we cannot decide on the market. Say suppose the general direction is long, and the what inventory report is saying short, then probably there is no affirmity on what was happening, so it's better to stay out of those market. And then if the general direction of the market is short, and the inventory report is saying long, uh, it's better to not to trade in that market. Of course there are more opportunity in when the direction is long and inventory report direction is short, because those two opposites will create extremely good position for a trader. But the problem is it can be more than very highly volatile. So you cannot predict what's going to happen. But if it's a very directional view of so like both are saying long, and inventory report also says long, then you have a chance that you for like a statistical edge, you have more chance to be right than you are wrong. So it's the preference is if your general direction and inventory report direction is aligning together, then go with the decision. Other times you can enter the market, but the problem is the market will be highly volatile, and you never know what's going to happen. Now let's see some of the interesting things you should take care while taking positions. These are some points. It's up to you to decide. End of the day, if the calculated trade decision is aligned, you can place your trade as long or short. That is what the general direction and the direction of inventory report aligns. Then you can go for whatever that is aligned decision. Like if the general direction was long and also the inventory report says long, then you can go for a long position. The another thing, if it's long and after the report the price surges considerably, wait till the price comes down to the certain untraded prices. The untraded prices means if the price jumps from 40 to say 41, all those prices between 40 and 41 are the prices that are known as untraded prices. The market has to come down, and market usually comes down to trade those prices. So if your even if your decision is aligned as long, and the price surged incredibly, and you are the and you should wait for your entry till those the market comes down to trade those untraded prices. So it's better not to enter in the market when the surging price surge happens. And you should never place market orders because you never know what price the market is going to execute your order, as there is the market maker is also involved. And if it's shorting, the opposite works well, which means you should not short at the bottom level. You have to look for the price the contract has missed trading when the sharp decline in price happened. This correction usually happens in the first hour of the trades after the inventory report. So if the report comes at 9:30, all these things happen before 10:30 a.m., something like that. Now coming to the main question, like when should you exit this position? You should place for 10 or 15 tick marks. You can easily go for the 10 or 15 tick marks in this kind of strategies. And if you should only carry for the position if you are seeing there is a huge volume that is aligned with the decision you take. So if you are going for long and you are seeing a large is a big long candle, then you can place, or you are seeing an extremely good volume in your favor, that is in the position that you are in, then you can carry forward the position. And if you are consistently in the market and you are not a position trader or a swing trader, then it's better to close the trade once a profit of 10 to 15 tick mark comes, and close the position and wait for the next time.